Good morning, everyone. I am Ernesto Burden, the publisher of New Hampshire Business Review, and it is my pleasure to welcome you to another New Hampshire Business Review webinar. Today, funding your startup and beyond, navigating the capital maze. Today, we're going to be talking about the funding strategies for your startup in today's volatile market. Our expert panel will demystify the funding landscape. We're sponsored today by Sheehan Phinney and Sheehan Phinney Boost, our moderators, who are also going to be our hosts today. So I'll introduce them and then step aside and let them take over. Are Matt Benson and Emily Penaskovic, both corporate attorneys for Sheehan Phinney. Matt, Emily, welcome.
Ernesto, thank you very much. We're glad to be here, and hopefully we'll be able to provide the audience with some useful and helpful information about some funding issues, questions, strategies. We're going to break up this morning into three different pieces, which I'll get to in a minute. But I did want to just quickly, again, reintroduce ourselves. Emily and I are both corporate attorneys at Sheehan Phinney. Spend a lot of our time working with startup companies and do help them try to address some of their funding needs and other issues that come up. And if you haven't already, you can take a look at the Sheehan Phinney Boost website and get some further information. So with that, we wanted to break this up into three pieces. First, Emily and I will give a little bit of a background on different funding alternatives. We'll try to keep that brief. We know that you're not here to listen to a couple of attorneys babble on for too long, so we'll try to keep that concise. Then we have a great panel of three others to whom we're going to pose a variety of questions, and hopefully those questions will align with some of the information that you're looking for and questions that you may have. And then finally, we will have some time at the end for Q&A. At the bottom of your screen, at least on my screen, if you hover below the slide, a window should pop up with a Q&A button. So if you do have any questions, you can utilize the Q&A button. We'll try to keep an eye on that, and as questions come in, we'll either try to address them as they come in, or perhaps at the end. So with that, I just wanted to start off and talk quickly about a couple of different funding alternatives. It really is kind of a spectrum of funding alternatives, some of which we'll focus on more than others. One of the primary funding mechanisms for a very early stage company is their own bootstrapping. And that can be resources of the entrepreneur. It can be maybe perhaps getting some pre-funding from potential customers and others, but doing what you can to try to get some capital in the door just to keep the company going and to get it moving in the right direction. Once you've maybe utilized all of those resources, one of the next steps is often what's called the 2 or the 3 Fs, friends, family, fools, the early investors and adopters of the technology that, or the technology you're trying to develop and the company you're trying to build. And they'll oftentimes invest in a variety of different forms because they really are there as a supporter of you, the entrepreneur. And quite often, we'll take the guidance from the entrepreneur in terms of what the entrepreneur is willing and able to provide, whether it's a convertible promissory note or maybe straight equity and some other alternatives that Emily will describe in a little more detail, and so will the panelists. And as you move down the spectrum and kind of leapfrog over some of the other options that we will talk about in more detail, on the far end, I guess, maybe off to the side, obviously, there are some companies that would qualify for government grants. And what's nice about grant funding is it's non-dilutive, meaning you don't give up any equity or ownership in your company to bring those funds in. It can be a very useful tool. It can also be very difficult to get. But at least it's an option out there we wanted to make sure you're aware of. So other than your own sweat equity and bootstrapping and the friends, family, and fools round and the government grant money, there are a bunch of other alternatives that we're going to focus on today, and I'll turn it over to Emily to provide a brief intro of those and then introduce our panel.
Yeah, as we move down that spectrum that Matt was talking about in terms of stage of the company and funding options that are available, if you think about the earliest rounds, they're typically referred to as the seed round. And usually that funding helps to support the business until it can generate its own cash or bring in its own revenue. And then later on, sometimes we refer to a Series A investment round, and that really helps the company to launch and further scale the growth that it has already started. So that could take place in terms of developing out the minimum viable product or increasing user base, but really scaling the company after the initial growth phase. And some of the different funding options that are available during those later phases of the process. One is taking in money from angel investors. So angel investors are accredited individuals who want to invest their own money in early stage companies. And in exchange for that, they take an ownership piece of the company. Usually when angel investors write that check, you're also, as the company, you're also getting some feedback or advice or networking, something in addition to, just the straight cash. So it does usually involve some kind of a relationship between the company and the angel investor. Angel investors are usually some of the first investors who are coming in. So their checks tend to be, under the $500,000 range. So we're not talking millions of dollars from angel investors. And sometimes, so I mentioned that angel investors, when they write the check, they would, in some cases, be getting equity in the company, so ownership. But another way that angel investors structure their investment is to use what's called a convertible note or a SAFE. Those are two different versions of a similar vehicle for bringing in investment. And with a convertible note, instead of the investor getting actual ownership in the company right then, they're essentially making a loan to the company that will convert into ownership at a future point. Usually that future point is when the company goes out and does a VC round, which we'll talk about in a minute, or goes out and takes a much larger investment and sells preferred equity to investors. And so the really early investors who wrote those checks initially and put in that loan, their loan would convert into that preferred equity if and when that time comes. And in exchange for the investors, the really early investors being willing to make that loan, they usually get a discount or other favorable terms on that preferred equity to reward them for putting the money in first and coming in early and helping the company through those initial stages of fundraising. So that segues into the next stage, if you will, of funding options, which is bringing in money from venture capital firms, or VCs, we'll call them for short. And with VCs, the structure is a little bit different. So usually VCs are getting preferred equity in the company. So they are taking an ownership stake. And generally that ownership stake comes with the ability to have some control over how the company is run. So it could be board seats, it has preferred investment terms. And we'll let our panelists dive into some of this in a little bit more detail, but at a high level, the VC round is when companies are usually bringing in more in the millions of dollars range, as opposed to hundreds of thousands. Another option to mention that sort of goes in between angel investment and VC investment is equity crowdfunding. And equity crowdfunding is a relatively new funding option, but it's certainly gaining popularity. And essentially that's a framework where startups can raise relatively small amounts of capital from a large pool of investors who are not necessarily accredited. So average, people who aren't necessarily accredited investors can go in through portals that are run through the SEC and can invest money in startups and have a stake in the game as well. So these investments have to be conducted through one of the federal funding portals. And as I mentioned, this is a relatively new option that's been changing a lot over the last couple of years. Startups should know that there can be pretty onerous disclosure requirements just to get up and running in these portals. And there are fees imposed by the portals and certain restrictions. So it's an option that startups, should understand exactly what they're getting into. And it's not a great fit for everybody, but it can be a good fit for some. And again, hopefully one of our panelists will be able to go into more detail on that aspect as well. And then at the very, later stage of this spectrum that we've been talking about is traditional bank financing. So usually really, really early stage companies that have a limited operating history and don't necessarily have much or any money coming in aren't necessarily a great fit for a bank loan. But on our panel, we'll dive into a little bit about when that starts to shift and when companies are a good target for bank financing and can utilize that option to bring in money as well. So just to recap, when it comes to early stage financing and startups trying to get in the money that they need to get their company off the ground, there's really no one size fits all option. There is this whole spectrum of alternatives. Some are going to make more sense than others, depending on what stage the company is in. And that's exactly what we'll dive into in a minute as our panelists join us here.
Was that our cue?
Excellent. Yes, and Jeremy, you can go ahead and join in. Excellent.
Right.
So here we have Holly and Jeremy, and I'm going to go ahead and let them give their own introductions and tell a little bit about the kinds of funding options that they're involved with. And then, and we also have Chris Lustrino joining us as well. So I'll let Jeremy, if you don't mind starting, we'll have you just give a little introduction about you and the bank financing and other options that you're involved with.
Sure. Thanks, Emily, and thanks, Matt. Really happy to be here and explain what my organization does. We're on the traditional debt lending through bank side of this. So I'm the senior credit officer at the New Hampshire Business Finance Authority. We're an economic development organization here in the state, and we have a pretty easy mission, and that's to have a positive impact on jobs here in the state. We do that through a number of loan enhancement and direct lending programs that we have. It's pretty wild because we'll be involved with anything from, like a $70 million real estate development for New Balance, all the way down to a $30,000 loan guarantee for a startup business in the state. For startups, the primary, program that we're using to help out is called the Capital Access Program. And what that is that's a loan guarantee program. And basically what that means is that a bank will make a loan to a borrower and we'll put an additional guarantee on that loan that basically says if this deal goes bad and there's a loss to the bank will be reimbursed for a certain percentage of their losses. We do that through fees. So when the bank closes a loan, there's a fee that's assessed to the borrower. And those fees basically get put into a giant loan loss reserve pool that we use to fund losses for banks. So this program has been around for, about 30 years. There's been about $260 million of capital deployed through it. I would say it's definitely our highest touch program. We see the most amount of loans going through this program. We have about probably like 15 to 20 different programs here at the BFA, but again, this one is definitely the more popular one and definitely the one that's used for our startup community here in the state.
Thanks, Jeremy. And Holly, why don't you go next?
Yep. Yeah, I mean, you gave a great overview, just kind of on the landscape and different options. I'll just give a little background on myself first, and then we can kind of get into some of the other stuff on the venture side. So I have about, over 2 decades of experience. I've been on the investing, operating, and board side. I'm currently the founder and managing partner of Apprentice Ventures. It's a venture capital firm based here in New Hampshire, which I launched earlier this year. I began my career in the industrial space at GE, did a 180 and moved to Wall Street, where I was part of a $4.5 billion principal investing group. Everything from very early stage venture all the way through to distressed. From there, I co-founded and ran a special situations fund called 8-Bar Partners, and that was a spin out from that principal investment group at Morgan Stanley, and have served on multiple global boards. Before launching Apprentice, I helped run a cyber startup. We raised 20 million of venture funding, and now at Apprentice Ventures, I'm really focused on founders and kind of who are digitally reinventing in legacy industries. Like businesses that have traditionally been slower to adopt digital innovation, and that can benefit from leveraging machine learning and AI. So that's kind of the quick snapshot on my background, and thanks for having me.
We also have Chris Lustrino here. Chris, are you able to, I know you're not able to use video, but we'll let you do an intro if you're able to.
Yeah, absolutely. Can you hear me all right?
Excellent, thanks. You can.
Awesome. So nice to meet you all. Yeah, my name is Chris Lestrino. I'm the founder and CEO of a business called King's Crowd. And essentially, we sit at kind of the apex of the equity crowdfunding industry. So for the past 7 years, we've actually tracked and provided investment research, analysis, and ratings on 9,000 plus private companies that have raised a mix of equity and debt capital from over 3 million individual investors. And we ourselves have raised over $7 million from 4,000 plus individual investors to build our company to where it is today. So I kind of come with the experience of understanding this wholly new way of raising capital on the equity crowdfunding side, where you're actually raising money from the general public, regardless of accreditation status, able to raise money, market your deal online like you would an e-commerce product, and raise capital and build community from the general public, which is a really, really awesome, unique new option for companies. And we're just seeing the space really explode. This year alone, there'll be almost 3,000 unique companies that raise upwards of $1 billion in this new way. So I think it's a really interesting lens to come with, especially because it still is a very new kind of nascent young industry. And so it is definitely becoming a viable and real path to be able to raise capital to build your business, whatever stage you may be.
Great. All right, well, thanks panel members. Emily and I have a bunch of questions for you, and hopefully those listening in do as well. And as I mentioned before, there is a button, Q&A button that you should be able to utilize. And if you have trouble with that, there's also a chat function, and we'll try to keep our eyes on both of those, but want to make sure that if you do have questions, we try to find some time to address them. One of the real goals here of the session is to provide you, the audience, with the information you need so that you can align your search for capital with the different resources that are available, right? So that you're targeting your search in the right direction. And in order to do that, you just got to have a pretty good understanding about what they're each looking for. And that is some of the questions that Emily and I will have for the panel. And to kick things off, for each of you, and maybe we can go in the same order for the first question, Holly, Jeremy, Chris, at what stage do you most commonly provide funding, and what are you looking for at that stage in particular? Do they have to be profitable? Do they have to have revenue? And then do you expect them to already be funded from somebody else? So I know it's kind of a three-parter, but what parts of those are most critical in your evaluation in making an investment decision? Holly?
Yeah, and I think it's also important to kind of note that the benchmarks, we in the venture industry keep changing what those are in terms of what's a real pre-seed round versus seed. Do you have to have revenue? I mean, I'm seeing a lot of seed stage deals have to have like 500 to 800K IRR to get those done. You rewind 3 years and that was not the case at all. So it also is very market dependent. So I mean, I primarily look at pre-seed, seed stage opportunities. I angel invest as well. The focus is often on companies that have been generating some level of market validation, either through early revenue, partnerships, or a clear path to revenue. For a company to be pre-revenue and come to us, we typically really need to see a very high potential market and just an incredibly strong founder market fit. If you're operating in these legacy industries, I think you have to really understand the different pain points, purchasing behaviors, how those operate, because they can move very, very slowly. And so it would have to be an absolutely outstanding kind of founder market fit. I think on the, do I expect prior funding before I invest? No, I mean, I don't really have strict requirements around that. I think it's common for companies I invest in to have raised an angel or friends and family or fools, as you said, I guess. I think that that kind of test helps founders kind of test the waters and validate their early hypothesis. It helps them kind of really hone in on their story for when they go and raise a seed. But I'm pretty flexible on prior funding. I mean, if the founders have bootstrapped and are super savvy at resource management, I mean, all the better. So I think we're pretty open on that front.
Awesome. Actually, I wanted to switch the order because I think it might flow better if we go to Chris, if you're available, Chris, to talk about some of the same things. What stage you most commonly invest in? Do you expect revenue, profit, and what level of prior fundraising might you expect to see, if any?
Yeah, great question. So first off, just to be really clear, right? So we are kind of an investment research data platform in the crowdfunding industry. If you want to go raise capital in this market, you're going to be going to marketplaces like WeFunder, Start Engine, Republic, Net Capital, so on and so forth. There's almost 100 platforms out there, though the top 5 or 6 are really kind of the key ones that most people will look at. But in many instances, it can make sense to look at some of the smaller platforms as well. Now, first off, where we can help is we can help you navigate that and figure out, what are the market comps? Where should I think about listing? What industries do well on what platforms based on the company that I am? What does that mean for me? So we can really help you navigate the waters of figuring out where you should think about listing your company if you're thinking this makes sense for you. Now, in terms of looking at the overall industry, what types of companies do well? It really spans the gamut. So it's all about level setting expectations. If you are kind of what I call a day zero company, a pre-seed company with an idea and a piece of paper, you have to set your expectations that you're probably only going to raise between, call it 75 and 500K that first time out. And it's probably going to require a lot of effort on your part to get those dollars into the deal because there's very little validation of your idea, right? That's the most risky place for people to put their dollars, and thus it requires more convincing and you bring to the table. Now, we see company, like I said, spans the gamut. We have companies that are just starting out to companies that are doing over $300 million a year in revenue. Companies that are, I'd say, doing anywhere between like $1 and $10 million in revenue tend to do really well. And that's partly because they have enough budget to set aside to really market their deal beyond just their own investor audience and that work on building community, so on and so forth. But at the end of the day, there is no expectation that you've raised money before, and really any stage of company can do this. It's all going to be about structuring the deal the correct way, deciding the right place to list, and then thinking through how you're going to market your deal, whether that's hand-to-hand combat and just meeting with people because you're a day zero company that no one knows about, or if it's going to be more of a full-scale marketing operation, in that type of style. So it really spans. It's all about just kind of looking at your numbers, looking at where you're at, and then talking about realistically, what can that mean for you as a business?
Gotcha. So Holly and Chris, more kind of equity side. Jeremy, you're more on the debt side. Same question. What are your thoughts?
Yeah, so I'll give everybody's favorite answer. It depends. As I was mentioning before, a lot of the deals that come into the Business Finance Authority are facilitated by a bank. They're the ones that are lending the money. We're putting the guarantee on the back end. We put a lot of faith in our lenders and what they want to support, and sometimes it's pre-revenue, sometimes it's not. What's more important is that it has certain benchmarks in place that allow us to actually put the guarantee behind the deal. And the big one has to do with your second question that you had is what level of funding needs to be in place. And we do require that there is 20% of equity contributed to the startup costs of the business in order to utilize this program. The equity that's contributed to those costs for starting it has to be from it can't be a borrowed source. So it can't be off of a HELOC or a loan from someone else. It has to be pure equity into the costs of that particular business. So as long as that's in place and the bank supports it, it can be pre-revenue or have a couple of years of revenue. It doesn't matter to us. That's the more important benchmark, the so-called skin in the game.
Those answers touch on, what stage the company should be in, when looking at all of these different options. I'd also be curious to hear a little bit about like what types of companies are the best fit. And Chris, it might be good to start with you. Are there certain companies that tend to be more successful using the equity crowdfunding vehicle specifically?
Yeah, unsurprisingly, right? It just like in any capital raising, it really does all come down to the founder. And I mean that from the perspective of, what are you willing to put into the deal, right? In terms of effort, in terms of, whether it's marketing dollars or working the deal, by, making phone calls and putting out updates and setting up investor webinars, so on and so forth. So, the 7 million that I've raised over the years, that's been almost done with zero marketing. And then I've seen people who go out and raise no money, and are saying, oh, it doesn't work and this, that, and the other thing. And that's because they weren't willing to work the deal. So it really does come down to the founder and their willingness to do whatever it takes to really see that deal is successful. But one thing I do want to call out, so like I said, I think any company can do well if you set the right expectations and you work the deal. But something that's really interesting that I don't think people, a lot of people thought the thesis was, oh, consumer businesses will do great in equity crowdfunding and everything else won't, right? If you're B2B, if you're a biotech, if you're healthcare, financial services, it won't do well because people don't understand it. And we're actually finding that that's not true at all. If anything, investors in this market, like any market, are looking for a really good return. So sometimes those like Shark Tank type companies, right, a real consumer product, like there's been many companies who've gone on Shark Tank who go and do crowdfunding and they do all right, but they don't like blow it out of the water versus a B2B SaaS company might do exceptionally well. And that's because people are looking for a good return and they know SaaS is a good, asset class or area to be invested in. So we actually see the entire gamut of industries do very well, and B2B and biotech have done very, very well in our space. So I say that because consumer already think it's a good idea, and it is. Consumer is still very good. But any other sector can work really well too. Industrials, transportation, we've seen it all. And companies across the gamut have done exceptionally well. And then it all comes back to the fact, does the founder, really work the deal?
And that I'm glad you mentioned that, because some of the companies that Matt and I worked with, a while back when equity crowdfunding first launched, and there were a lot of misconceptions originally, I think, around equity crowdfunding and what the involvement level was. So where we saw people not be successful is where they just assumed, oh, it's like a set it and forget it situation. We get up in the platform, we press go, and the money just flies in. And I'm glad you mentioned that that's not the case. It's just like any other kind of fundraising where there is still a component that the founder needs to be really involved in, just like VC funding and any other option.
Very involved. Yep.
Excellent. And then Holly, just to feed off of that, are there certain industries or certain product services that are a better fit for different VCs? How do companies know, who to seek after when they're weighing different options among VCs or angels?
Yeah, I think one thing I would say about that is wherever you're building, I don't know the latest number on the number of VC firms. There is a VC or an angel that is interested in what you're building. It's find your people, right? Like I specifically will focus on like the intersection of AI and legacy industries, and that's B2B. So if that is not you, that's okay. There is a GP or a firm or an angel investor that will love what you're doing. And so it's just kind of spending that time and reaching out to folks to find who that is, because it's, finding the right people is really, really important. I think, like VC funding is like, it's really for founders who think they can tap into like very significant revenue opportunities. Like you're either looking to completely redefine or invent a market that does not yet exist. When you take VC funding, like you have to believe that you can grow at a really good clip within like a decade timeframe. So think like 100 million ARR within a decade or so. Because venture funds, we typically have a 10-year horizon, maybe a little bit longer. We accept money from limited partners who expect that capital back at a good multiple. So just, you have to understand that you are selling equity in your business. That venture firm is going to be involved in your business. So if you don't want that, think really long and hard about that. And then we have to seek a return, and that's typically through an exit, right? So if these things don't kind of fit with what you want to build in your vision, that's totally okay. And like, that's why all these funding options on the call right here are perfect, because there are alternative sources, but VC is a very specific type of funding.
And Jeremy, same question for you. Are there certain, for bank financing, are there certain types of companies that have a certain asset class or something that can be used as collateral that tend to be a better fit earlier on than others?
Yeah, definitely. So, no particular industry in particular, but what a bank is looking at when they're making a loan is, if this whole thing blows up, how do we recover our losses? And usually that's through some sort of tangible asset, whether it be with a company or personally, that the bank can tap into. We're part of that as well, acting as a guarantee on that loan. So typically, a company that would be good for their, the capital access program that I'm describing is one that can put collateral forward, whether it be through the business or personally.
So just a follow-up question. We have our first question in from the audience, which is, do any of you have a particular preference for entity type? You know, say corporation versus limited liability company, say New Hampshire formed versus Delaware formed. And maybe let's go in reverse order this time, Jeremy. We'll put you on the spot first.
Sure. There aren't any restrictions and related to the type of entity that would be allowed in the program. So no. Again, if the bank supports it, we'll support it as well.
Very good. How about you, Holly?
Typically Delaware C Corp is preferred.
Gotcha. And Chris, what do you see in the companies that come to you looking to figure out where to get equity crowdfunding?
Yeah, typically we do say to become a C Corp if you're not already. The challenge with the LLCs is, you could start having the K1 issue. A lot of platforms now have created an ability to roll up all investors into an SPV. So even if you raise from thousands, it's still only kind of one investor on your cap table. But in some instances, that's not the case. And you just don't want to run into a situation where you have to develop, 500 K1s or 1,000 K1s. And also people just don't like the idea that they might have to get a K1 at the end of the year and deal with it. Even a lot of angel investors now tell me like they don't want to deal with K1s. It's just another thing they have to deal with. So C Corps are definitely preferred. We are seeing more people actually move away from Delaware, and Nevada and Utah are becoming more popular for privacy reasons, a couple different things, but Delaware is certainly fine as well.
Very good. So I think that the audience would also be curious to know about the terms of the funding that you would provide. And I think that you'll see that there's probably a difference between maybe the more debt-based versus the more equity-based. But Chris, starting with you, what terms would you expect an entrepreneur to have to consider if they're going out to find equity crowdfunding? What rates of return would the investors expect? I think if it's equity, we're not talking about repayment of investment necessarily, at least not like a loan. But what are the other terms that you think are most critical to have in mind?
Well, one of the nice things about this market, right, is unlike VC, right, there's a lot of different types of investors in the crowdfunding market. So, some people are looking for more stable returns, and that's where we see companies with, 20 million in revenue that have been around for 15 years that are looking to exit in the next 3 to 5 years. And you're fairly confident they're not going to go under, but you're also not going to get a 10x, right? Maybe you're going to get a 2.5 or a 3x, but investors are okay with that. And then you do have those more venture style investors who are, looking for that moonshot. That's a, AI company, an idea on a piece of paper and saying, hey, this could be really big. I believe in the founder and I want to be in for the ride. And then you have people who are looking for those debt investments. We see a lot of rev share deals for, breweries and restaurants and things like that, where it pays out, a 2 or 3x over a 4 or 5 year period as 20% of total revenues. The beauty of being in this market is you can really decide, hey, based on my company, what makes sense for me, and set those terms. Now, the valuations, the structure always has to make sense, but you can pick, do I want to use a SAFE? Do I want to use a convertible note? Do I want to give away preferred equity? Do I want to do common shares and have it be a price round? Do I want it to be a debt vehicle? So you can decide as the founder what makes most sense for you. But again, you always have to think the terms have to be attractive enough, right? So we have actually found that companies raising in the CF market, the crowdfunding market, on average over the last 2 years have been 52% lower valuations than the venture market. So people are looking for competitive pricing, especially because it's so transparent and investors can see all the deals. They'll give you a hard time. If you're priced at 10 million as a pre-seed company and everyone else is around 4, you're going to get a hard time. So you do have to have competitive pricing on the actual valuation of that security.
So a variety of different types of investment opportunities is the companies that might approach crowdfunding, paired up with a variety of different types of investment terms that they might expect to see. Holly, how about you? In your world, maybe a little bit narrower in terms of the target company and maybe a little less flexibility in the terms, but what's your feedback?
Yeah, I mean, I think at the pre-seed seed, like I'll look at kind of 250K to 500K checks in exchange for equity ownership. Think like 2.5 to 5%, right? So I'm okay if that initially comes in the form of a SAFE with some sort of valuation cap. I try to look at under 10 in the AI world. That gets it gets a little bit different. Or preferred shares in a priced equity round. I typically ask for pro rata rights so that I have the ability to participate in your next funding round. Don't typically, seek a board seat at this stage. From like a returns perspective, like we kind of have to look at each investment in terms of, can this one investment, if everything goes right, return my fund? And so that's kind of how we underwrite most of our companies.
Gotcha. Jeremy, how about you?
Yeah, so we're not seeking any particular rate of return. What the loans that we're guaranteeing are going out either via term loan or a line of credit to the borrower. The terms around that are going to be what would be considered pretty commercially standard in a bank loan. So if it's like working capital, equipment, you're probably going to see a term of somewhere between 5 to 7 years. If you're looking at, a line of credit, there's usually going to be some sort of, renewal period. But we don't necessarily restrict how the bank structures their debt with the borrower. We just look to make sure that it's what we would consider as commercially standard.
So to pivot from that, I want to talk a little bit about what the investment process looks like. A lot of companies who are going out and looking for these different funding options, this usually is the first time that they've gone through that process. And when Matt and I work with startups that are looking to raise capital, there's a lot of education involved in, okay, here's what to expect for the process. So could you, Hall, I guess if we start with you, could you touch a little bit about what startups should expect in terms of the due diligence process and just getting prepared for funding from investors?
Yeah, I mean, I honestly think the best founders I've seen at this, just kind of like, they do all the work up front, so they're not answering the same question over and over from 15 different investors, right? So they build out a strong data room or a pitch deck, even if they're early, right? That's okay. Like even if you put together like a 10-page memo, like with all the things that you're going to get asked, because fundraising is hard. You have to talk to a lot of folks before you get a yes. I mean, in 2021, that may have been a lot different, right? And you could raise a lot quicker. It's kind of swung back the other way. So hopefully VCs are doing their work and diligence. So like, I mean, like for a typical process for me, it's usually, a quick pitch with the founder, dig in for, a week or so with follow-up, but like the process from beginning to end is still a couple months long. And like I said, I mean, there are different VCs that focus on different things, so for whatever you are building, there is a right home for you. It's just kind of finding that. But doing the work up front, I think is just really important just for your own sanity and to make your life a lot easier. Because I've been on the other side of the table raising, and it's not, it's not fun.
And what's involved in terms of when you get to the point of agreeing on a term sheet, what is that negotiation like, or how does that part of the process flow?
Yeah, I mean, a lot of times, like especially if it's pre-seed and we're just investing on a safe, like be very standard in your terms, right? Safes are literally, I mean, they're called simple agreements for future equity for a reason. They're simple and there's very standard docs. So if you use something that most people are comfortable with and, you don't have any weird, interesting terms kind of, strewn throughout the document, it's going to be really easy. I like safes just also be, when you're really early, like it's not a lot of legal costs. It allows you to close really quickly. I think, so I mean, like that for us is super easy. When you're doing a price round, there's a little bit more to it in terms of then you're starting to talk about, voting type things and control and provisions around, what you can and can't do. But like I think the transparency is really key. And I think you have to keep things very simple. Like as soon as if somebody sends you a term sheet with, 25 pages and crazy stuff, just go find someone else.
Good advice. And Chris, it's a little bit different when companies are preparing to launch in, say WeFunder, Start Engine, or one of the other equity crowdfunding platforms. How can startups best anticipate that process, which is, pretty unique, and what are they expected to have ready to go before launching?
Yeah, it is, fairly labor intensive. And what I would say, especially your first time through, expect from the day you decide, like, yeah, I think I want to do this to when you launch to be about 2 months. And then expect to run that campaign for somewhere around 3 to 4 months. So, pretty much comes down to if I'm looking for funding, expect it to be about a 6 month process from end to end. Certainly it can be quicker, but just on average, let's say it's somewhere right around there. And it is a unique process. So the things that you're going to first have to do is one, decide, okay, what platform do I want to work with? And then that platform does have to accept you. While they're not too super stringent, there are certain requirements that each platform looks for. And so you might want to work with a start engine and they say your deal is too small, you don't have enough traction. You might, want to work with a deal maker, Net Capital, and they might say it's not a good fit. We Funder is typically very flexible and willing to work with almost any stage company. That's usually the easiest one to get on. So first, you kind of go through the application process of meeting with their biz dev teams and seeing if you're a good fit. Once you've decided, okay, this is where I'm going to list, now you have to put together all of your documentation. So in order to do a regulation crowdfunding round, you have to put together something called a Form C. And what goes into a Form C is basically disclosures around who owns what of the business, what are the terms of the deal, what are all the risk disclosures that I should, be aware of, right? There's a going concern with the business going out of business because we don't have enough money. We work in a regulated industry, so you have to put out all of these kind of risk disclosures. And then you're going to have your financials in there. So if you're raising up to $1.2 million, you have to have CPA created financial statements. Even if you're a brand new company, they have to create statements saying that you have no assets, you have no income, so on and so forth. So you have to put all of that together on the legal side. You obviously have to have the security ready to go, whether that's a safe or convertible note or common shares, whatever that may be. So all of that documentation has to be put together. There's bad actor checks included with that. And then you have to create an offering page. And that's where you're actually, think of it as your virtual pitch deck. And that's where people are going to go learn about your business and then are going to click invest and actually invest in the deal. So all of that has to be put together prior to being able to launch. That gets filed with the SEC. And then basically, as soon as it's filed, then you can begin raising and actively market your deal. And then once you're in the the raising part of the round, then comes all of the work around investor outreach, updates, investor relations, webinars, marketing, so on and so forth. And that process will typically run 3 to 4 months. Now, the two really nice things about doing a crowdfunding round is one, after your round has been open for a month, as long as you hit your minimum, which is typically 50K, you can do disbursements of those funds into your account, even if you haven't hit your maximum. So you could pull down 50K and utilize that to kind of fund your business while you continue to raise capital. And you could do that, every couple of weeks, few weeks, you could do a disbursement of funds. So you don't have to raise all the funds at once. And the other thing that's nice is if you don't end up, fully pulling off the round that you want, right? Maybe you were shooting for $1 million and you raised $500,000. It doesn't mean that you failed and now you're done. You have $500,000, right? So at least you have something rather than nothing, which I think is nice. Sometimes when you do go out for a more institutional round, right, it's kind of all or nothing. You either get it or you don't. So in this space, there's room for, hey, we were not as successful as we wanted. We're going to pare back our plans, but we still have some money to continue to fund the business. And like I said, that whole process, you're looking at somewhere around 4 to 6 months from end to end.
Thank you. And
Yeah,
Jeremy,
Emily, I would add to that just because Chris brought it up. I think transparency is really, really important, like especially in the venture side. I mean, I know that there's kind of this like, fake it till you make it kind of thing that's come out of Silicon Valley. But if someone has, maybe they took funding and they pivoted and whatever, or there's something messy in there, like if you're transparent about it, it's totally okay, right? Like, but if you go in and an investor starts to do diligence and starts to see strange things that you haven't actually brought up or talked about, we move on pretty quickly. Like I actually don't mind messy stuff at all, right? But just be very transparent about it.
early stage companies are bound to have messy stuff.
Yeah.
Sure.
Yeah.
Thank you. And Jeremy, the process for applying for a bank loan or going the traditional debt route, I'm sure is quite different as well from each of the other two options. So can you touch on that piece?
Yeah, absolutely. And so you're going to see a standard bank underwriting process. Obviously you have to have a bank that you're working with or one that you're interested in working with. They're going to collect your financials. If you're pre-revenue, they're going to want to see the projections. And then also there's got to be a pretty specific use of the funds that you're asking for. At that point, once it's collected by the bank, they bring it into underwriting, where they decide if it's a viable deal or not, and what kind of collateral they would need on the back end to make it work, or guarantees from an organization like the Business Finance Authority. The process, it varies based on the complexity of the request. Obviously, as the request becomes more complicated, it takes a little bit longer, but if it's a pretty straightforward request, like you're just looking for equipment for your business, it can usually move pretty quick. On our end, once we get inquiry from the bank to provide a guarantee, within this program, we usually provide feedback within 48 hours. And our process for actually finalizing the guarantee is pretty quick as well. Doesn't really take any work on the borrower side. It's more of an agreement between the bank and the Business Finance Authority.
Great. Just want to remind the audience, there is an opportunity again, if you do have specific questions, to put them into the Q&A box, and we will try to address them as they come up. Here's a question. We kind of alluded to this. Maybe Holly, you did a little bit in terms of mistakes entrepreneurs can make if they're not transparent. But other than that, what are the other biggest mistakes that you see entrepreneurs make when they're approaching you, any of you, for funding? And Holly, let's start with you. You brought up the transparency thing, but what else is on your mind? And things have you seen come up that are problematic as you're trying to assess an investment opportunity?
Yeah, I mean, I think one is probably just around the approach, right? Like, you do a little bit of work, right? Like, understand what that venture firm is interested in, if you can. It's not too hard. I mean, I don't have a website right now, but if you go on LinkedIn, you can figure it out pretty quickly, right? You don't want to be pitching your consumer startup to me, because, I might be able to connect you to someone else, but like, just do a tiny bit of work. But I think just kind of like on evaluating an investment, I think one of the biggest mistakes is entrepreneurs a lot of time just focus too much on like product or features without really connecting them to kind of like the actual customer pain points. I've seen a lot of startups build really cool technology and products without validating that the customers actually care and would pay for it. I mean, you could spend a really long time and a decent amount of money being like, and it could be a really cool technology, but at the end of the day, it might not matter. And I think that can really end up being a startup killer. So get those validation points really early. It's also why I like founders that really have been like ingrained in some of these industries for a really long time, because they just understand like the behaviors, purchasing decisions, all the different players who are active in the market and how things move. So yeah, I mean, I think make sure you're actually solving a pain point and a true customer need before you start building out.
Yeah, just some of those pet projects and technologies that the inventor loves may not actually may be harder to turn into a business.
Yeah, I mean, and think about too, like if is this a business or is this a feature, right? And you kind of have to really think through that, like especially. I'll just use like kind of like the cyber market, for example. We see that often. A team will spin out, and really it's what they're building is a cool feature that should be kind of, tucked into an actual platform or a product. And so like, are you actually building a standalone business and have a plan and a vision to kind of get like, to get somewhere big, right?
Sure. Chris, what are your thoughts on mistakes that you've seen entrepreneurs make along the way?
Yeah, there's three that really stick out to me. The first one is valuation. So because you can set your own terms, right? Some people make the mistake of thinking that means I could do whatever I want. I don't have to sell very much of my company at all. And then they go and they way overprice it. And guess what? No one invests. It's like they think it's dumb money because it's retail investors. And actually, I'd say because it's their own hard-earned dollars, they're in some ways more risk averse than a VC at times, and they will grill you. They will absolutely grill you, and you won't raise any money. And I've seen it. The second thing is how you interact in the Q&A sections of your offering. So on every Reg CF offering, it is legally required that you have a Q&A section where people can write in questions. And if you try and dance around questions on there and don't answer them directly, if you're not coming across as transparent as Holly mentioned, that's where you get yourself into trouble. And I've even seen people get into almost confrontations where they're basically giving a hard time to the person, like, how dare you almost ask that question, around my financials or whatever. And it never goes well. And people, I would say, outside evaluation, the next most critical thing they look at is not the offering page, it's how you're interacting in that Q&A. If you're super honest, transparent, real with people, responsive, even on the hard stuff, you answer it honestly and transparently and say, yeah, this is where we went wrong. This is where we struggled. And believe me, I've been there. People have grilled me, and I just answer as transparently and openly as I can. You will win people over and raise a lot of dollars. But if you're confrontational there, you lose a lot of trust and people won't invest. So that's the second thing. And then the last one is not thinking about how you're actually going to get money into the deal. People think, yeah, if you build it, they will come, or the platform's going to bring all this money to me. And what the platforms will typically tell you is, if you bring half, we'll bring half. So if you bring $500,000, we'll bring $500,000. If you bring $1 million, we'll bring $1 million. And what that comes down to is, you still need to work the deal. Before you go live, you should be figuring out every asset that you have in your network, from friends and family saying, hey, literally, like, what is every friend that could put $100 into my deal? What is every former colleague that could put $1,000 into my deal? What is every customer that I think is highly engaged and loves our product enough that I can have a call with and win them over and get them to come into the deal? And then what are my other assets? What are the other lists and LinkedIn connections and so on and so forth that I can do outreach to? Thinking about all the things at your disposal, recognizing that everybody can be an investor, and then figuring out how you're going to reach out to those people, engage them, and get them to come in to build validation in your deal, so that people on the platform who just discover you and don't know you at all will want to come into that deal as well. And so people who just kind of, they do all of the legal, they put everything together, but they don't actually think about how they're going to market their deal to their own audience and do outreach, they struggle mightily. They come out of the gate with nothing. That creates concern around the raise, and then oftentimes, they'll struggle through. So you really got to think about how you're going to get those first dollars into the deal.
And Jeremy, what are your thoughts? Maybe you don't see any mistakes in your world.
Well, we definitely do. But I would say the big mistake that I see is oftentimes someone calling us with a startup business gives up pretty quick, because they'll talk to one bank and they'll say no, and they'll just assume that's what every bank's going to say. But I will tell you that every bank is wildly different into what they're into. We get calls all the time where we'll talk to a bank and they're like, yeah, we're not originating loans right now. Or we'll talk to another bank saying, hey, we're open for business. We're trying to take on new loans. So it really depends on who you're talking to. So just because you get a no from one bank doesn't mean that you shouldn't approach another. Usually when we get a call, from an entrepreneur or, someone looking to start a business, we'll often give them like 3 or 4 different names of banks that we know work these programs and are making loans to startups. So it's never good just assume that just because one bank said no means that all banks are going to say no. The other thing I would say is that if, with a lot of these bank loans, I would say all of them, they're going to require some personal guarantee from the borrower. Don't understate a credit issue if it exists there. If there is something in your personal credit history, disclose it up front. Because that'll just be helpful in the conversations going forward. It's not necessarily a disqualifier, but it can certainly be one if it's not something that you brought up from the beginning.
And
Okay,
we actually have oh, sorry, Matt.
Oh, go ahead, Emily.
We actually have an audience question that builds off of this discussion, and that is, do you have any advice for a startup where the founders are technically competent regarding the product, but not savvy on the business side? And maybe even just to round out that question, what are there other qualities that you look for in the core team, other than the technical aspect? Holly, do you want to kick that off with what you've seen from early stage founders?
Yeah, I mean, listen, like there's no one size fits all. If you are, I happen to really like folks that have been in some of these legacy industries, but that's the nature of where I'm investing, right? Does that mean that 2 technical co-founders can't come in and like build something truly amazing? No. So like, if you think you have the right, like you're addressing a real pain point in that market, it's totally okay. But what I would say is then build your team around you with folks that kind of fill in those other gaps, right? So if you are, building for commercial furniture, for example, right, and you've got this great, vertical SaaS solution, and but you don't understand the players or the folks in that industry, then make sure you either through advisors or early hires or whatever that might be, try to just fill in those gaps and kind of where you need to. But there's no one right way to do it, for sure.
And that is a good point too, that business partner can take different forms in terms of finding someone with the business acumen. Doesn't necessarily need to be someone who owns a piece of the company. It could be an advisor or team of advisors. Great. Chris and Jeremy, anything to add to that in terms of the early stage team and what you look for if there isn't a business acumen?
Yeah, just if you're approaching a bank loan, there are resources here in the state that can help you prepare a package to present to a bank. One would be the SBDC, the Small Business Development Center. It's always good to chat with these resources, just kind of see where you line up and what areas you can work in. And a lot of times they can provide resources to help you with some of that business acumen. So explore all resources. They are out there.
Yeah, and the last thing I'll add is in our space, if you have the resources, call it 20, 30K for your round. There are consultants who can kind of be your fundraising quarterback, and be the one who helps you figure out all the people you should be reaching out to and helps with all of the outreach and sets up meetings, so on and so forth. So there are resources that can help you if you have some money to put against that. But I think if you're really a technical founder, you have to ask yourself, like, do you want to have to do the business side and ultimately decide, do you want to hand that off to someone and bring in kind of that, founding executive that maybe, doesn't have as much ownership as you, but has a meaningful stake where they could kind of take charge of running the business side? Or is that something you really kind of want to keep control of? And then if that's the case, you probably have to think creatively about how you're kind of going to manage the business and utilize consultants and advisors, so on and so forth. But I do think you need to think through that, because there's a lot involved in just doing the fundraising and the management of the business. And that just might not be what you want to do. And you should really think critically about that.
Right. We've just got a couple minutes left, actually. And I just wanted to ask one maybe final question, give you each, say 30 seconds to address it or so. What trends are you seeing? How are you seeing things in your world kind of evolve? And are they kind of pro-investor, pro-entrepreneur, or other things you wanted to point out? Jeremy, let's start with you. I feel like we've made you go last most of the time.
So I would say the big trend that we saw, especially over the past year, is obviously with the elevated rate environment that had a direct impact on bank lending. We saw a pretty large slowdown in the small business lending portfolio that we run. I would say to counter that, right around October when they started announcing the rate drops, that changed dramatically, and we've seen a lot more activity from the bankers and optimism from the general market about what bank loans are going to look like and if it's going to be affordable based on the rate environment. So we're anticipating that to continue in 2025. And we're also anticipating to see a lot of debt refinancing of prior debt at the higher rates. So I think that's, like I said, that's probably what we're going to be seeing in 2025.
Holly, how about you?
Yeah, I mean, I think it's kind of a tale of two cities. It's like AI, and then there's everything else, right? And like there being like companies building in those spaces versus not, or just operating in very different environments. There's a ton of down rounds, and it's a much more investor-friendly environment for, I would say, non-AI startups, and then probably the flip side for AI startups. I think the really exciting thing is so we've been looking a lot at like AI CapEx spend and like in the second order effects from that. And so if you think that we're basically spending like nation state level investment in AI CapEx. So regardless if there ends up being a bubble at some point, whether 2025, 2026, like the infrastructure and the foundations have kind of been built, and there's just going to be some amazing startups that are going to come out of that investment and being able to build on top of that. So I mean, I think 2025 is going to be pretty exciting. I hope liquidity opens back up a bit. Venture funding should tick back up. I do think that AI is still going to consume most of the oxygen in the room. But yeah,
Right.
it's an exciting time though, for sure.
Chris, last word, just in 30 seconds or so.
Yeah, absolutely. I think what we're finding is that, this market has been around for about 8 years and it's finally beginning to mature and is becoming very clear to a much broader base of founders that this is a real and viable path to not only raise capital for your business, but perhaps become the main funding vehicle for your business. We ourselves have grown our business, over the last 7 years solely by raising capital in these markets. And we're seeing more and more companies like that are building incredible communities of investors. There's a business recently called EnergyX, and it raised $75 million from 22,000 investors. But they've been doing multiple rounds of funding over the past 4 or 5 years, and they just keep getting bigger and bigger because they're building these huge communities that are following them and continuing to follow on and invest in them over time. And that's a really exciting trend because it does become a real and viable new source of capital that can fit a lot of different businesses. To Holly's point, it's AI and everything else. If you're everything else, this is an area where you can find real capital to grow your business, which I think is really exciting and puts more power back in the hands of the founder as well. So anyway, that's what we're seeing.
Yeah, great. No, appreciate it. So we're a little bit over time. Just as by way of a public service announcement, I did want to remind everybody, if you haven't already, go do your Corporate Transparency Act filing. If you have a small business and small company, don't forget to do that. But before the deadline for existing companies or those that exist before this year is the end of the year. So it's quickly approaching. Make sure you get that taken care of. And I'd like to introduce Ernesto to come back in and help close us out.
Hey, thank you very much, Matt and Emily and Jeremy and Holly and Chris. Wonderful job, all of you. I've been racking my brains throughout the entire presentation on which business to start first. As soon as able to round up all of these amazing funding opportunities. Thank you, Sheehan Phinney, for sponsoring today's webinar, and thank you everybody who attended. We appreciate you greatly, and have a wonderful rest of the day.
Thank you.
Thank you.